Warren Buffett says most investors only need one fund. So I wanted to see how that advice actually compares to modern income investing. And we're going to compare that to two other individuals, Ray Dalio with his all weather portfolio, which is designed to survive literally any market condition. But when I ran the numbers, the results were not what I expected. And then we're going to look at the Dave Ramsey portfolio, the aggressive growth mutual fund style. Dave Ramsey claims this investing strategy can build massive wealth, so I tested whether the numbers actually hold up. So stay tuned. Welcome back to Simply Money. Today we're going to be comparing three different portfolios, one by Warren Buffett, one by Ray Dalio, and one from Dave Ramsey. Just a quick overview, Warren Buffett believes that most people should just have a simple one fund S&P 500 portfolio with an example setup of about 90% S&P 500. We're going to use VOO and about 10% in treasury bonds. Whereas Ray Dalio, he has the all-weather portfolio. He has this set up, in his opinion, to hold up against any market. But what kind of upside do you give up to have that stability? We're going to be looking at about a 30% stock allocation, 40% long-term bonds, 15% intermediate bonds, 10% gold, and 5% commodities. And we've chosen VTI, TLT, IEF, GLD, and DBC for these funds. And this is going to go up against the Dave Ramsey portfolio. If you've watched Dave Ramsey, he talks about an equal four-part fund made up 25% each of large cap growth. We're going to use VUG, 25% growth in income. We're going to use SCHD, 25% growth. We're going to use QQQ, and then 25% international, and we're going to use VXUS. Now, Dave Ramsey talks a lot about using mutual funds. These are not mutual funds. There's going to be a little bit of difference in those. He never gives particular funds. He always just gives the different sectors and categories, those four categories, and that's what we're going to be looking at. And he talks about the 12% annual return, and we're going to see, is that realistic? We're going to look at a spreadsheet that I have, and we're going to compare these. So let's dive right into that. Okay, so here's our Simply Money Portfolio Planner. If you've not seen this before, you can get a copy of this if you'd like down at the Buy Me a Coffee link in the description below. All of our spreadsheets are available there. What I've done is I've set up the Warren Buffett portfolio in our conservative model. So we have VOO at 90% and TLT at 10%. Over here in the moderate model, we have Ray Dalio with 40% in the TLT, 30% VTI, 15% IEF, 10% in GLD, and 5% in DBD. And in the aggressive model, we have the Dave Ramsey portfolio with 25% VUG, 25% SCHD, 25% QQQ, and 25% VXUS. What we're going to do on this first scenario, we're going to look at a couple different things. First, we're going to look at just simply investing $10,000 and letting it ride for 30 years. We're not going to add anything to it. We're just going to compare these three different portfolios with $10,000 over 30 years and how do they do. We come over here to the forecast tab. Right here we have our models, conservative, moderate, and aggressive. We'll start with the Warren Buffett on conservative and come down here to the end of year 30. You can see we're at $273,000. So remember that. Warren Buffett's model, just basically an S&P 500 with a little bit of bond in there. You're looking at $273,000. Now you're going to have a volatility with that. The beta obviously being basically 1 with everything in the S&P 500. Now let's look at Ray Dalio. How do you think that did? Before we get going too much further, leave comments down below. Do you use any of these models? Do you like any of them? Do you dislike any of them? Have you not heard of some of them? Leave me some comments there. We're going to compare some other models as well in another video. Now let's look at the Ray Dalio model on the moderate. Click that over and you can see right here, only $109,000. Big difference between the Warren Buffett model of 273,000 and the Ray Dalio model of $109,000. Now we're going to go to the aggressive model, which we have for the Dave Ramsey model, 25% in 4 different funds equally. What do you think that did? Leave me a comment down below. Do you think this one outperformed? Did worse than these? What is your thought on that? So here we go. The aggressive model we have looking right at $295,000, almost $296,000. So with $10,000 invested, adding nothing else, just letting it ride, the buy and hold, we put it in there, we leave it. Obviously, you did better if you followed the Dave Ramsey model. This is based on past performance. Obviously, we don't know what the future will hold. And remember, this is not financial advice. This is for informational and educational purposes only. But that model, based on past performance, did better than the others at almost $96,000, where Warren Buffett's did $273,000. So about $26,000 more, which is pretty minimal when you think about it over a course of 30 years. Just a slightly different sequence over the next 30 years could make that up or down in either one of those to do a little bit better. Both of those, I would say, are pretty equal in the big scope of things over the course of 30 years. Again, we're basing this off of past performance. Now, I would say that the moderate model definitely underperformed. I would be fine if I said, okay, I got 273,000, 296,000 over 30 years. Again, a pretty minimal difference, but this is a huge difference. You're looking at 164,000, 180 something $1,000 difference. That is a huge difference. Yes, your ride may have been a lot smoother in this model when you had some of those big crashes like 2008, 2009, when you had the 2020, the COVID, when you had 2022 market crash. This was probably a lot smoother ride along the way, but the long-term outcome, you paid for that stability. And that's a big thing to remember, especially if you have 30 years, that riding out the volatility can definitely make a lot more opportunity for you. Now we're going to look at something different slightly. We're going to keep everything how it is with the $10,000 initial investment. But what we're going to do now is we're going to look at what if we add $500 a month to each of these funds for 30 years. So we have a $10,000 initial contribution. We put $500 a month in. And if you look at the first rule, that's what we're going to look at first. This is going to be the Warren Buffett rule, where 90% of this $500 will go into VOO and 10% will go into TLT. We have this set over at the forecast to conservative, which is the Warren Buffett portfolio. And we come over here to the Forecast Pro. Whenever you're doing deposits, whenever you're using rules, you go to the Forecast Pro because it has a much more dynamic reading for you. And you can see here that VOO brings in about $1.7 million, TLT about $61,000. And if you come over to the total portfolio, you can see that you're about $1.69 million. $1,769,000 with the Warren Buffett model. And that's $500 a month on top of that initial $10,000 investment. And for those that are income focused, you can see that you're getting about $1,800 a month in income generated from the dividends that are being paid off of that. We want to come back over to the deposit rules. We have this set up here. So all we have to do is put this one to 0. And rule number 2 is going to be the Ray Dalio all-weather portfolio. Again, $500 a month. If you come down here to rule number 2, you can see 40% of that $500 a month will go into TLT, 30% to VTI, 15% to IEF, 10% to GLD, and 5% to DBD. And we got to come over to the forecast, change this conservative to moderate, so everything's running. And then we come over here and we see that only $996,000, just under $1 million. You're $760,000 less over 30 years when you're making deposits. Now, when you just did the $10,000 and you just let it sit and you held it, you didn't do anything with it, there was a big difference there. But when you're adding dollar cost averaging month over month for 30 years, your end, a lot of people will be, well, I'll be happy with $1 million to retire. But wouldn't you be a lot happier with almost $8 million using the Warren Buffett model? Now let's go back over here. We're going to change this to 0. We're going to go to rule number 3, which we have set up for the Dave Ramsey model. And here you have, out of that $500, 25% going into each of these: VUG, SCHD, QQQ, and VXUS. Now, again, remember, these tickers that I chose are not the ones they actually say to choose. Warren Buffett says an S&P 500. They're all basically the same. VOO, FXAIX, where these others, I chose these. You can go in, these are the sectors, these are the focus that they're giving you, and I chose tickers in these. You could go ahead and change these, like SCHD, maybe you put Devo, or maybe you put a different type of income and growth in there. You could pick different ones for these models. So this isn't necessarily going to be exactly the same depending on which funds you choose, but all of these funds that I chose have done well in their different categories. Now we're looking at $500 a month on top of the initial $10,000 investment in our Dave Ramsey model. Go over here to aggressive on the forecast tab. Then we go to forecast pro tab and look at that, $2 million. You're actually 300,000 more with the Dave Ramsey model than just the S&P 500. Now, again, you could pick some different funds that maybe would have done worse. Maybe they would have done better. It's not quite as easy to select those as it is Warren Buffett's. You just pick an S&P 500 fund, an index fund, and you let it go and you're done. His is a little easier to pick and decide. With Dave Ramsey, unless you're in an account that automatically rebalances, you have to look at that, because remember, he wants you to be 25% in each. And look at the breakdown at the end of 30 years. You're very heavy in QQQ and SCHD, then a little bit less in the VUG, and you're way lower in your international fund at only 200,000. If you were rebalancing every year or every 5 years, this could look a lot different as well. Because if you look back here at year 10, maybe you've been holding this and you're like, whoa, wait a minute, I'm getting kind of heavy here. This isn't too bad right here. This is pretty close. But as you go further down, let's go to year 20, and you start looking and say, well, QQQ is getting pretty heavy. It's more than double of VXUS. I need to balance this. And that could impact what your actual outcome would be. Or you take the chance that you're getting out of that 25% equal balance. Those are things to consider when you're looking at these different types of portfolios and how they would turn out if you rebalance them annually, quarterly, every 5 years, every 10 years. Everybody deals with that differently. And you have the different cycles that the market goes through. So you have to watch that. After a huge bull run in the tech, QQQ may be way out of whack, and you want to sell some of that and put it into, say, VXUS to balance that, but then you lose some of that upside if QQQ continued on a bull run if you rebalance too early. There's a little bit more tweaking and playing with these different portfolios that you have to deal with. Whereas someone like Warren Buffett's portfolio, the S&P 500, you just basically buy it and forget about it. And that is why he recommends that for most people. And so leave me your comments down below. If you're an inactive, hands-off type of person, do you prefer the Warren Buffett style or maybe more of Dave Ramsey? Or are you going to want more of a smoother ride and follow Ray Dalio and say, I'll give up some of the upside, but I want a smoother ride? Where do you see these fitting in people's portfolios? I personally, if I was talking to somebody who has no background in investing, has no interest in following it, they just want to invest and get the most that they can without having to toy with it, I would go with more of the Warren Buffett style, in my own opinion, or maybe even a JL Collins. And we'll compare that into another video on another day, when maybe we'll put up the Warren Buffett against Collins portfolios and see how that does. We can look at these different portfolios, different scenarios. Again, this isn't perfect analytical data. This is past performance, hoping that the future would be the same. whether you rebalance, all sorts of factors could change that. What are your thoughts on this? Leave me the comments down below. I appreciate you joining me as always. Again, if you like this sheet, you can go ahead and pick any kind of tickers we have over here. If you buy the sheet and you don't see tickers you want, you can ask me, email me, and I'll add those for you. And then you can run different scenarios, whether you're using the same tickers and you put different allocations to be more conservative to more aggressive to compare one portfolio, just different allocations, or do like I did here, where you set up 3 different portfolios. There's a lot of different things you can use this for just to get some ideas. This is not going to be perfect. Again, past performance does not guarantee future outcomes. So always remember that. That's it for today. Thank you for joining me, and we'll see you next time on Simply Money.